Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending April 19th. Well, seems like a lot of people are talking about a market melt up. I don't really quite see it that way, but clearly we've had a pretty good move up higher. This past week, just about all major U.S. indexes, as well as all global indexes, were up. Although we did see the Russell down just a little bit, 1.2%, and the S&P was essentially flat. It was down 10 basis points for the week. But the Dow was up about 60 basis points. Nasdaq up just 20 basis points. Volatility still relatively flat. It was up just a little bit, but it finished the week at 12.09. And then across the global markets, the FTSE, the London index, was up about 31 basis points. The CAC 40 was up 1.41%. The DAX, the German index, was up 1.85. And then over in the Asia Pacific area, we had the Nikkei up about 1%. Chinese markets were up just slightly under 2% at 1.93%. Also for the week, we had just a little bit of a roundup here. The best performing sector was technology, up about 1.16%. And the worst performer just getting killed because of some of the statements by some of the Democratic presidential contenders like Bernie and a few others. XLV was the worst performer. Talking about Medicare for all. So XLV for the week was down another 4.58%. And the prior week it was down a little over 2.5%. So it's had a pretty bad couple of weeks. And we're looking at the PE ratio. The trailing PE ratio is about 21.74, but the one I like to look at the most is the forward PE, but it's still getting a little bit rich now. 17.35 is the current PE ratio. So remember, last January, before we had the big fall off, the PE ratio was a little over 18.5. So by historical standards, 17.35 is still a bit rich. It's generally about the 15.5 range historically, and we're at 17.35. Now, again, we're also in the midst of Q1 U.S. corporate earnings cycle, as they are in Europe and over in the Asian markets as well. But most people focus on the U.S. markets when it comes to corporate earnings. And though so far we're about what analysts expected, about 3.8% lower year over year, but it's actually coming in a little bit better than folks are thinking, right? The bottom line we're showing, the top line, I guess, is missing a little bit worse than expected, but the bottom line is beating about 77%. But keep in mind, this is from a already lowered guidance, okay? And we got commentary from some of the respective CEOs of major banks, and all of their statements tend to say that the U.S. economy is still good, the consumer is still spending, the credit markets are still okay, banks are lending, wage growth is very strong, as you guys have seen, retail spending is very strong. That came in March, one of the strongest we've had in quite some time. So I don't see a recession this year. I still see a little bit of a grind higher, maybe some pullback, some scare the children moments, but I do not see a recession this year. We're also seeing globally the yield on most government debt is still extremely low. So that's, forcing money to seek riskier assets to increase yield. So they're going more into junk bonds and some equities. That's going to create more turmoil in the next bear market. But for now, that's what's happening. And we still have over 9 trillion plus of government debt worldwide that is still yielding negative interest rates. So that in and of itself is still not that good. But I still, we're kind of in this grind higher mode right now. What you see on the screen is the E-mini S&P 500 futures. I'm going to keep this session and this weekly roundup relatively brief because it's a holiday weekend with the Good Friday this Friday and then Easter holidays over the weekend. And most global markets were closed on Friday, and many in Europe are going to be closed on Monday and some on Tuesday as well. U.S. markets to be active on Monday. closed Friday and this weekend. But if you look at it, I've got a regression channel on here. This is the E-mini S&P 500 futures. You can see as late as Thursday, we made new 2019 highs. Okay, and we're very close to taking out the September all-time highs at 29.47. And it's just been a grind mode on this regression channel. We've been generally staying north of the center line of the regression channel, and every time we've gone south, and in that rare instance, and only once have we touched the bottom of the channel, and we've only stayed in it for just a few days. And then over here in March, we stayed in it for almost a week. But we quickly, as you can see here, have been riding the top of this regression channel. We fell below it just briefly on Friday. We were able to manage our way back up. Now, the S&P did finish flat to slightly down 10 basis points, as I said, for the week. But you can see here, we're still very strong in the market. Okay, on this daily chart, you can see the MACD shows no divergences near term. So any dip here is probably going to be bought. You can see my value area on the chart. That's where the buying and selling volume equaled out on a 90-day look back period, because I'm using a daily chart. You can see here it puts us right at just slightly under 2,800. And now we've just had an extension off of that with buyers taking control. And of course, if we look at the Dow market is really, let me just get rid of that here. You can see on the Dow, we blew right through my target area. Remember, my target was 26,446 in the center, and we're sitting around that now. We actually made new 2019 highs on Friday, and we closed near the highs on Friday. Okay, these are the Dow futures. I've got an anticipated, notice this is a 3, 4, 5 pattern right here, which would suggest we're going to get an ABC chop, which would lead an A leg down just slightly going into next week. But keep in mind, next week we got 150 companies coming out for earnings, so we're going to start to get into the thick of it for earnings next week. We're going to see on Monday Halliburton come out, and the regional bank Zion. But then we're going to start to get into some big earnings on Tuesday with Coke, which is more of an international kind of play. We're going to see Procter & Gamble come out. We're going to see Texas Instrument, Twitter, Verizon on Tuesdays, just some of the bigger ones that are coming out. And then Wednesday we get Biogen, Boeing, and Caterpillar, which are big Dow movers, CMG, Chipotle coming out. We get Facebook on Wednesday. PayPal also on Wednesday, Tesla and Visa. So Wednesday's going to be a very active day. Then, of course, Thursday, we get Altria, AbbVie, Amazon, Bristol Myers, UPS, Starbucks, Ford, Raytheon. So we're going to have, and then to end the week, we get a couple of big mobile oil players, Exxon and Chevron. So we're going to have this week, we're going to see they're going to have the propensity to drive the markets lower or higher depending on where they go, especially from a tech perspective and from a healthcare perspective. So I'm looking at this as a possible slight weakening into next week, but I still do not see a recession setting up, at least looking at price action and the technical patterns of the charts. Okay, and look at Nasdaq. Nasdaq was the only index that made new all-time highs. We took out the prior September highs in Nasdaq on Thursday at 77.3350. Now this is Nasdaq, so this is the Nasdaq futures, which is just 100 of the largest companies in the Nasdaq index. And if we look at the cash index, the composite index of Nasdaq, you'll see here it's slightly different. Notice here we did not make new all-time highs. So this suggests here that some of the smaller companies in Nasdaq are not following through like they are in the larger tech. So this would suggest that the larger tech companies, i.e. some of the FANGs as well, are really driving Nasdaq higher. Okay, you can see here in the composite index of Nasdaq that we have not made new all-time highs, but we did on Thursday make new 2019 highs. And then if we look at kind of like what I have here as a Fang Index of stocks in the Fang, you can see here it too is following that regression channel higher. And then on Friday, it closed near the high, but we made new 2019 highs. So we can say, and look at the MACD, there is no divergences in this, bearish divergences. So this does suggest that the FANGs are still kind of leading the way as we go to the upside. And I did say the sector that was the best performer this week was technology. Now we're going to get some of these big technology stocks coming out. We've got Facebook, as I said, coming out. We've on Wednesday, we got on Thursday, we got Amazon coming out. So we've got some big, they're going to start lining up this week and next week. We got Twitter on Tuesday. So we're going to start to get some of these guys hitting, and it's really going to drive this. But you can just see here this upward grind higher in this Fang Index, which is really a combination that I have here of Facebook and Apple and Microsoft and Google and Amazon. You know, I don't include Netflix in this one. I could, I guess, but you could see here the strong move that we've seen moving higher. Now let's look at the Russell. Remember, the Russell was the one that concerned me the most. You can see this was the only one that had a downsloping regression channel here. But you can see how we move back up. Now we've come down and we've tested the top of this regression channel. You can see this volume area here right at 1561.58. This is where the highest volume took place. Typically where bulls and bears, buyers and sellers were pretty much equal. And we've generally price action tends to seek out these levels, and then we just kind of consolidate here. We have not made a new 2019 high in the Russell since the end of February, in this case, February 25th. All the other indexes have been making new 2019 highs. The Russell's the only one that has not. Now, I had a target here of the Russell to complete this move here up around 1634, but I've got to see some energy in this move here. If we come back into the regression channel, then we're back into this, which would give me a little bit more of a sour note on the markets. Remember, the Russell peaked early in September by 3 weeks before the other markets peaked, and then the Russell was well into its decline when the other markets started to follow suit. So I'm looking to see if that pattern repeats. Now, the other one that I'm watching closely is the transports. If we look at the transports here, you can see how it looked just like the Russell. We had made a high in transports going back to the third week in February as well. But then we took out this regression channel. We've also got the 50 crossing, and then we came right up to my target, and that's kind of where we settle now. Remember, I had my target at 197.51, and we closed at 197.57. We did eke out a new 2019 high. So this would indicate, and this has kind of been following the Russell, that the Russell is going to play catch up and should move higher. Okay. But we've got to watch these very closely here to see how this thing plays itself out. Okay. If we do look at the all world index, which is Vanguard has VEU. You can see here we made new 2019 highs on Thursday again. So we've been, you know, I could draw a regression channel on this one as well. I mean, if I were to put it in here, I didn't do it, but if I were to kind of put it in here, you know, you could see here that even on the all world index, now the highest volume area here over price was at 49.92. So the bulls equal the bears. Typically price tends to find these areas and stay here for a bit. But you can see how we're north of this. So we're still getting the bullish play here. Now, I do not have the 50 over the 200 here. All the other indexes has the 50 over the 200. You can see the MACD's been giving us these successive divergences here. And then the most recent one from this move here from a 4-leg to a 5-leg, it's been flat. So that suggests any move lower is going to be bought. Okay. And then if we look at Asher, which is the tracking stock for China, you know, we made new highs here back in April the 5th, you know, about 15 days ago. But we're still hovering near the 2019 highs. And China, the Chinese markets have really been on fire. Okay. Now let's look at volatility. If we look at the VIX, you can see we closed the week at 1209. So we're well in the green zone here, right? Now I color code my chart. It helps, depending on what zone I'm in, is the strategies that we're going to use, whether we use options on equities, options on futures, or some commodities. But this just kind of helps with some of the strategies and just gives you a market view of where the fear gauge is sitting. And right now it's very low. And just to kind of add to this, if we look at the front month vol futures, you can see we're in the green. So that says we're in a backwardation a contango environment in the market. That is a normalized term structure for volatility. All right. That means the VIX is less than the front month vol futures. Now, this past Wednesday, we had everything shift over. So now we're now into the May vol futures. Now, the back month uses May and June, and you can see here we're even deeper in a contango term structure. So this means that going out at least through June, through the early summer months, the markets are not that fearful right now. Now, understand how volatility works. It tends to be a mean reverting animal. So this is a good time for those of you that may not have them to put on some what we call our FOBAR hedge, right? That's a military term of, F up beyond all recognition. That's what I call it, my FOBAR hedge. Now, there's different hedges to do. We have hedges for portfolio margin accounts, and we have hedges for Reg T accounts. So for our members, you know which ones and how we set them up. So we'll be looking at that this coming week. As long as vol stays low, it's a good time to be looking at hedging, okay? Treasuries, you can see the bond market came off of these highs here, and we're sitting near, we found support at the value area here, sitting around 145 and 28 ticks. So you could see this pivot high and pivot low right here. So we're going to probably form a new pivot area just south of that pivot low. So I think these earnings are going to continue to drive the markets. I think it's already got in place about a 75% of the results, maybe even 80% of the China trade deal. I know the Trump administration in China, they're going to be meeting again over the next week or so to try and finalize this thing and come up with some kind of agreement that they can sign sometime in probably May timeframe, or maybe even June. But the markets believe that's going to be a done deal. All right, so we will get a little bit of a pop, but again, a lot of the market action is already predicated on that deal being done. But then right up next after that is going to be the European market trade deal and then China. So that can add a little bit of agita to the markets as well. But that's kind of where we're looking. If we look at the 10-year interest rate, you can see here, we're going to be hovering around my spot price here of 2.5. That was my target. We blew right through it, came all the way down to 2.35. Then we came back up, and we're kind of finding this as a resistance or a support point. Right now, it's going to be a support point for us. So that's kind of where I see interest rates. So I think the Feds are still on the sidelines, although we've had very strong wage growth or very strong employment and that's going to keep a little bit of a pressure on the wage growth side of the things. That can have a tendency to raise inflation, but the Feds are already out saying they're going to let inflation run a little bit hotter than normal. So essentially, the Feds are on the sidelines. I don't see a rate cut this year. I know the markets had thought that was going to be the case as early as just 2 weeks ago, 3 weeks ago, but I don't see that being the case right now, not with wage growth as tight as it is. But I don't see a rate hike either, not this year, not unless things dramatically change. So that's kind of what I'm looking at there across the credit markets right now. And of course, if we look at the dollar, we're still in this very wide, and let me just zoom out a little bit. You can see the regression channel does show that it's inching higher, but it's a very choppy move, right? So down at the bottom, we want to be buyers. At the top, we want to be sellers of the dollar index. But if you prefer to trade the euro or some of the others, it's just the opposite, right? You can see clearly the area here. Let me get that off the screen here real quick here. Let's just do this and come back to it. So you can see here the downward path of the euro. And I think it's just going to continue this downward path in a choppy way, because Europe's going to be lucky if they grow 1% this year. For us, I think we get our first pass at GDP for Q1 on Friday. Okay, and the forecast is for it to come in around 1.8%. And that's down from original forecast of 2.2. But again, that's just what FactSet is saying. But let's see what we get on Friday. Okay. But either way, this is the movement in the euro. So I'm going to be a seller of the euro towards the upper part of this band and a buyer of the euro down towards the middle. But for the euro to stay within this band. Okay. The British pound, what a mess the Brexit has been. You can see here that we were basically long the pound until we got below this area here. And as I said, if we take this area out right here, this pivot low here going back a few weeks, which is around 130, if we take out 130, then I'll be short the pound. Okay. But right now, this was just a long trade in the British pound, or FXB, when we were down at the bottom of the channel or at the top. I was more willing to either take profits or get out of the trade or short it to get back into the channel again. Okay, so it's a little bit about the currencies. Now, energy, oil is a really interesting market. It is truly a headline market. Okay, it's controlled right now by OPEC, Libya, Iran, and Venezuela, and basically the geopolitical elements around those countries. And that has really moved oil up dramatically in 2019. Okay, and if we were to look at it from where it came from, you can see this move right here. I mean, it's dramatic. I was telling our members to get short oil up in this area here, and then I was telling our members to get long oil around December 28th area right here. Okay, it was a good entry on both sides, right? We've had some members take it and make a ton of money in the oil futures market, but I think we're starting to get a bit stretched here. Okay, remember, the only thing that's holding us up right now in this oil market, we still don't have the 50 over the 200, is the production cuts by OPEC. Russia's already starting to say they're losing market share, so they may back off some of that. We got the Libyan problem, so that's taken oil off the markets. We've got Venezuela, which has taken a lot of oil off the markets, and then Trump and Iran. Trump's due to make a decision shortly on whether he extends the sanctions on Iran or let companies continue to buy Iranian oil, which is what he prefers. Trump does not like high oil prices, so he's kind of caught between a rock and a hard place. On one side, he wants to punish Iran and prevent their oil from getting out in the global markets, but in doing so, that's going to drive oil prices higher, and he wants a strong economy. So it's going to be really interesting to see how he plays this. But this is a geopolitical trade right now. That's why I'm on the sidelines, or if anything, you want to be long until or unless we break out of this upward regression channel here. Okay, gasoline is the same thing. Look at gas. It is really to the moon, right? I mean, we're riding this thing all the way up. And again, it's going to be the same thing. We're starting to see some divergences in gas. And like I said, once we get up to these levels up here, I'll be more interested in looking at possible short rather than a long. But you can see gasoline is closer to coming back up to its prior highs up here than oil. It's just really overextended a good deal. So I do believe we're going to be in for some consolidation to some downward move. Okay, so that would be what I'm looking at in the energy markets right now. And then, of course, if we go to precious metals and we look at gold, the pattern that I saw in gold, the cup and handle pattern, is no more. And then we broke this pattern right here. You can see I've got this trend line here. And if it almost looks like a head and shoulder, we got a fourth head on here, so maybe it was a DNA spliced head and shoulders. You got two heads on the thing, but we broke that level right there. So that to me would be more of a shorting opportunity than being long. I mean, the actual short was triggered here on 415. Okay, I was looking for a retest of this neckline, but we didn't get it. And as long as price action stays below the 200 EMA, I would be more short gold than I would be long. And the other one that we're looking at here is Palladium. We've actually started to move back up, which is what I like. Remember, we had this big move down. I had a trigger on a trade here for our larger accounts because this requires about $500,000 in the account to trade. And for our members that have plus $500,000 more, taking a short on that trigger date right there on March 22nd was good. We had some members take the trade and make about $30,000 a contract in just a couple of days. It was a great trade. It just fell off the table. There was too many. It was too exuberant. Now you can see this value area here where price is held, 1342. It's moving up. I suspect this will move up north. It should move up at least to 1450 area to this pivot level right here. And if it does, then I'll be looking for another short setup. But for right now, I'm out of the trade. I'd like to short it, but I want this run to the higher it goes, the more I will be interested in looking at a short, okay, in Palladium. So that's kind of where we're sitting there. And one other one that I've been showing you now for the past couple of weeks that I like is if you look at lean hogs. I'm not ready to shut this. This is the swine flu issue. You can see here with lean hogs, we had a very quick trigger right here, in and out, tiny profits or stopped out. But I like this to the downside. I don't think it's ready. As I said, if it takes out the 92, 91.7 area, I'd be more interested in going short. You can see the pivot zone here, but you can see that huge gap up again. Pork is an elastic product. You got the elasticity of demand coming into play here, so it's easy to substitute chicken for pork, unlike other commodities. So that tends to, they say that the cure for high commodity prices is high commodity prices. So that is very true for the meat market. So this is what I see in pork. I'm going to be interested in this thing here shortly. Really, the best way to trade this, the only way to trade this one is in the commodity market on futures. So that's what I'm looking at on pork. There are other things that are going on in the markets. For our members, we've got a rare Sunday evening off. It's Easter Day on Sunday. So for our members, we will be meeting again for our pre-market live session Wednesday morning, 7:30 New York City time. Okay. Otherwise, everybody have a great holiday weekend. And members, I will see you in our live chat room Monday morning. Take care, folks. Ciao now. Have a good day.